So we'll start with the final review of the FRM Part 2 curriculum that will tell us about some current issues in financial markets. So an important but relatively straightforward section. So we'll just go through the various issues that the Institute has chosen to highlight in the curriculum this year. The first relates to the US House of Representatives Subcommittee report on MF Global. So on February 2008, MF Global trader Evan Dooley took a short position in more than 16,000 contracts of wheat futures. Now these trades were for his personal account, not the bank's account, and were well in excess of his trading limits. Bypassing the compliance and the risk management of MF Global, the company did not discover these trades until the price of wheat had increased, resulting in a $141.5 million loss. Since MF Global as a company was a clearing member of the exchange through which Mr. Dooley had traded, the liability fell on MF Global, and MF Global was required to cover these losses, and incurring these losses essentially on the bank's books and for the bank's shareholders. To stabilize its financial position that had deteriorated because of the fallout of these rogue trades and other incidents, MF Global sought help from a private equity fund controlled by J.C. Flowers & Co. The fund agreed to provide a commitment of $300 million towards the sale of equity-linked securities. So essentially J.C. Flowers & Co. purchased equity-linked bonds of MF Global and provided them the much-needed capital. So even though there was some interim relief provided by this transaction, the situation throughout 2008 to 2010 continued to deteriorate for MF Global, and eventually the company had to shut down, as we'll see in the coming slides. So by 2010, MF Global was in serious trouble, and there were several factors that contributed to this. First was the Dooley incident that we just described, which destroyed investor confidence on the risk management and oversight. Stock price had fallen to less than $10 per share, down from $30 per share. An approximate $2 billion drop in market capitalization, which the bank had to suffer. The bank, in order to increase its income and increase its sources of revenue, had applied to become the primary dealer with the US Fed. So the primary dealers are essentially banks or dealers that help the Fed do its open market operations, that is the sale and purchase of treasury securities. But for various reasons and the fact that the holding company was outside the US, the primary dealer application of MF Global got stalled, which further reduced investor confidence and did not bring in this stream of revenue. The bank had a leverage of approximately 35:1, that is for every $1 of equity, it had $35 of customer deposits and other liabilities. There was the global financial crisis, which further added to all the problems. Declining revenues and profits because of a lack of diversified revenue stream, and losses for 3 years in a row, further compounded by rating downgrades by credit rating agencies that further increased the cost of borrowing and the cost of debt. So the CEO Bernard Dan resigned on March 17, 2010, and John Corzine assumed the position of CEO of MF Global on March 23, 2010. Now the risk exposure at MF Global changed dramatically during Corzine's tenure. So several factors contributed. First, Corzine decided to turn MF Global into a mini Goldman, that is a full-service investment bank, and further wanted to engage in proprietary trading to increase profits. However, these activities, as we'll see, also resulted in significant increase of risk at the bank. Corzine moved into new lines of businesses without first restoring MF Global's core commodities business to profitability, thus straining resources and increasing risks. Corzine decided to invest heavily in European debt, believing that the bonds were less risky because of the European Financial Stability Facility (EFCF) bailout fund that would protect bond investors against default. So even though the European crisis was unfolding, Corzine decided to invest heavily into European debt. The bonds had significant liquidity and default risks, and Corzine did not develop a strategy to manage liquidity risks if ratings downgrades resulted in margin and calls and haircuts. Please note, proprietary trading is when the bank uses customer deposits and uses its own funds for trading and earning profit from trading in the markets. So rather than just being a broker for funds and other clients, in proprietary trading, the bank itself starts taking bets on various markets using its own money. So this can enhance profits, but of course all losses would also then directly be held or be borne by shareholders. In the traditional banking business, the banks don't have any proprietary positions. They act as brokers or they act as intermediaries. We'll see how this European debt eventually led to the shutdown of the bank. So margin demands started to put a strain on cash reserves and negatively impacted the company's liquidity. The culture at MF Global was such that no one was allowed to challenge any of Corzine's decisions. So we saw in F.1.1 situations like these were the major cause of many financial disasters in the past. Corzine surrounded himself with longtime colleagues such as Bradley Ablow, former chief of staff in the New Jersey governor's office. Corzine required Michael Rossman, the head of risk management, to report to Ablow rather than directly reporting to the board of directors when he disagreed with Corzine about the risks inherent in the European bond RTM strategy. RTM stands for repurchase to maturity. That was the characteristic of these bonds. He ultimately fired Rossman, and this was crucial because Corzine was chairman of the board of directors. So once he fired the only man who was disagreeing with them and who could have flagged off the risks to the board of directors, there essentially was nobody to disclose what actually was happening and what the risks were. Preventing Rossman from reporting to the board effectively cut the board off from all but Corzine's opinions on the risks inherent in the firm's European strategies and other strategies. Corzine also made himself the chief trader, which insulated his trading activities from risk management oversight. As nobody in the bank generally disagreed or wanted to challenge Corzine's decisions. The size of the European RTM portfolio was negotiated between Corzine and the board of directors, which he chaired. Ultimately, the size of the portfolio far exceeded reasonable limits. In the end, the portfolio was 14% of the total assets. The size of the portfolio, coupled with losses caused by rating agency downgrades, ultimately prompted a run on the bank by investors. So a run on the bank essentially is when all depositors and all creditors immediately ask for their money back or withdraw their money from this bank and put it in other banks or safer assets. So this is a very serious situation because if all liabilities suddenly have to be repaid, then the bank will have to liquidate its assets, and that liquidation often may happen at big losses. So there was a run on the bank by investors, customers, and counterparties. Corzine had not put a liquidity risk management plan in place. Responsibilities around regulatory compliance, liquidity, and cash management was scattered across various departments. Corzine further requested increases in the position limits on the European debt and RTM strategy multiple times, and the board, which he was chairing, continued to approve the increases. Not until June 2011 did the board of directors, in further reviews was found, even appeared to question the increases. And even after the questioning and even after this time period, they still continued to approve Corzine's request. But before this time, there was no resistance put up by anyone at all. Overall, the board seemed to support Corzine over concerns expressed by the chief risk officer. With respect to the response of risk managers, Rossman, the original chief risk officer, expressed concerns fairly early on. When he expressed these concerns, to Corzine and the board, Corzine started the search for a new risk officer. After Roseman expressed his concerns to Corzine again about escalating risk, it was confirmed that he would now be reporting to the COO and not to the board. Corzine replaced Roseman, that is, he fired the chief risk officer in January 2011. Stockman, the second chief risk officer, supported the requests for larger and larger positions until July 2011. In general, it appears that Corzine was not interested in the opinions of the risk managers, as he ignored their advice completely, replaced a chief risk officer who openly questioned the increased risk from the European RTM strategy, and removed the direct connection between the chief risk officer and the board of directors. So the other key decision makers did not get the correct picture. They were pretty much getting the picture that Corzine was presenting. When MF Global began buying the European bonds and using them as collateral for the RTM trades, it accounted for the transactions as required by the FASB. So the requirement at that time was that the European bonds that were used as a collateral for these trades were initially recorded as a sale. Even though these bonds were just a collateral and had to be bought back, the firm initially recorded the collateral process or the collateralization process as a sale and de-recognized the bonds from the balance sheet, and simultaneously recorded a forward commitment to repurchase these bonds, because the bonds were only a collateral. So they were given to somebody and then they had to be bought back at the end. So the forward commitments were accounted for as derivatives. FASB requires that derivatives be marked to market daily at fair market value. MF Global used this requirement also to their advantage, that is, they determined fair value using a fairly complicated valuation method that included the probability of default of the bonds as a separate component. So essentially what you need to understand is that MF Global took a view on European bonds, and they were positive on European bonds and European debt. For the reasons that we explained earlier, that Corzine was quite confident that the yields would compress as the EFCF facility that is there would not let the bonds default. As the crisis was worsening, the spreads on these bonds kept on expanding, and there were margin calls and other associated problems. So basically, it was a concentrated bet that was going wrong. To initially hide the losses, Corzine was essentially doubling his bets, that is, increasing exposures. Then he was also, as we see here, trying to manipulate the accounting so that the losses were hidden. Eventually, PwC, the firm's independent auditor, advised MF Global to revise its derivatives valuation methodology associated with the trades, leaving out the probability of default component. So the mispricing and whatever positive spin they were giving to the numbers had to then be reversed. Corzine was unhappy with the advice, but in January 2011 revised the methodology for valuing the forward commitments. The European RTM strategy significantly increased the liquidity strains. As the crisis worsened, margin calls increased and liquidity demands grew. Instead of using the firm's $1.5 billion liquidity facility or traditional repurchase agreements to source liquidity to meet these margin calls, MF Global increasingly relied on excess funds on deposit with its FCM accounts as a source of liquidity. So the FCM business was the futures commission merchant business, wherein customers had probably given MF Global certain excess margin money or excess deposits in their accounts, which is what MF Global was drawing upon to meet these liquidity constraints. So essentially, these liquidity constraints were again met by other liabilities that were not permanent or that could have been called back. So these excess funds, the depositors or the customers could ask back, and then MF Global would have to again arrange for liquidity. Margin calls escalated, and MF Global needed $400 million in margin to cover its positions by September 2011. The CFO Steenkamp told Corzine that the company was in a period of sustained liquidity stress due to the European RTM trades. According to Steenkamp, the broker-dealer business could not fund itself. Steenkamp said that using excess funds on deposit in the futures commission merchant business was becoming a permanent solution to fund the broker-dealer function. So we see that the liquidity problem originally started from the European bonds because of those concentrated bets and concentrated derivative positions, wherein now more and more margin money had to be put up. As more margin money had to be put up, strain increased on the other businesses. The broker-dealer business otherwise was becoming more unprofitable for external factors, and probably because people didn't want to trade through MF Global. And we see that the FCM business was essentially funding the losses in all other businesses. The Financial Institution and Regulatory Authority (FINRA) consulted the Securities Exchange Commission and the CBOE and determined that SEC's net capital rule required MF Global to take capital charges against the European bond positions even though the securities were sold according to FASB rules. So those European bonds that were kept as collateral that MF Global was showing as sold, we see originally had a commitment that they would be repurchased after a point in time. There was a derivative commitment that they will be repurchased at some point in the future. So even though at the moment MF Global was showing these securities as sold and hence not keeping any capital charge, that 8% of the risk weighted assets or nothing like that was being kept for these bonds, the SEC later determined that a charge needs to be kept. FINRA was concerned that MF Global may not have sufficient liquid assets to satisfy its obligations in the event of a liquidation. Therefore, FINRA ruled that regardless of the accounting treatment of the bonds, the SEC's net capital rule required that the European bonds be considered in the net capital calculation. So the bonds would be treated like a non-convertible debt security for the purpose of deducting haircuts in the net capital, and the balance sheet equity would be unaffected. Once MF Global lost the argument, Corzine and the financial team tried to negotiate a lower capital charge, arguing some of the bonds should be treated like treasuries, that is, there are no default risk because a lot of them were on European sovereigns, and the charge should be discounted 80% because default risk was the only relevant risk, and because they were on sovereign or they were sovereign bonds, the default risk was minimal. FINRA disagreed with MF Global and increased the net capital charge to $287 million, that is up another $183 million. So further $183 million of equity was needed as a capital charge against these bonds that were earlier being shown as sold off the books. The final days of MF Global revolved around meeting the ever-increasing liquidity demands due to margin calls and meeting the excess net capital charge required by FINRA and the SEC. Moody's downgraded MF Global in late October 2011. Eventually, the firm started using customer funds to cover draws on liquidity, that is, deposits were then being channeled to counterparties who had demands on liquidity. By the end, there was a $900 million deficit in customer funds. When a potential merger partner heard the funds were missing, that is, of the total bank depositors or the total liabilities, there was a $900 million deficiency after liquidating the assets, or as what could potentially be made out. So when the partner heard, any chance of a deal fell through, and MF Global filed for Chapter 11 under the US Bankruptcy Code. So that's what happened with MF Global, and basically just highlights that how concentrated bets, lack of diversification, lack of liquidity can be detrimental and can cause big banks to shut down in a matter of a few months. So we see that the crisis originally began because of these concentrated bets and the hopes to revive the bank immediately by Corzine. So there were problems at the bank earlier because of the rogue trading issues, etc. Then Corzine came in and wanted to revive the bank immediately, took on very aggressive positions, tried to ignore the risks, cover the losses, and eventually the strategy didn't work. He could not hold on to it long enough, and the company went bankrupt. The next case is titled JP Morgan Chase Whale Tales, a case history of derivative risks. So in 2008, the Chief Investment Office began calling its trading in synthetic credit derivatives the synthetic credit portfolio. What synthetic credit derivatives are, we've seen in the review on credit risk. So these are again positions on credit risk taken through credit default swaps and other structured instruments. So this portfolio made money for the first 4 years. In 2011, the net notional value of the SCP, that is the credit portfolio, increased from $4 billion to $51 billion, a more than 10-fold increase in value. The portfolio continued to grow, tripling between December 2011's $51 billion to $157 billion in value in March 2012. Risks also increased with the size because these were credit positions, these were derivative positions, and fluctuations could happen. The portfolio was massive and engaged in high risk, complex, short-term credit derivatives trading. By early 2012, losses started to swell in this division. The synthetic credit portfolio lost $100 million in January, $69 million in February, and $550 million in March 2012. A $0.7 billion quarterly loss. By May 2012, the SCP reported losses totaling $2 billion. Reported losses from the London whale trades increased to $4.4 billion by the end of June and $6.6 billion by the end of 2012. So in the rest of the case, we'll study as to why these losses happened and why were they not reported and what were the risk management failures in the disclosures and the accounting for these losses. In early 2012, the Chief Investment Office changed its method of valuing credit derivatives. So traditionally, the daily value was established by marking derivatives at or near the midpoint of the daily range. So this was the accepted method, and the midpoint prices complied with the requirement that derivatives be valued at the most representative of fair value, which would be the average of the bid and the ask. In late January 2012, the office started valuing derivatives based on the most favorable price in the daily range, allowing the office to report smaller losses in the profit and loss reports it filed with the bank each day. So the hope here probably was that the trades would recover at some point in time, and hence they were just trying to diminish their losses such that they didn't catch anybody's eye. So the reduced reporting of the losses was one risk management failure. The others came in the ignorance or in turning a blind eye towards the various risk metrics that were breached. So the investment office used 5 key risk metrics. The risk metrics were repeatedly breached in the first quarter of 2012. The firm either downplayed the risk, that is said that it's not as high, or raised the risk limits so as to enable them to take that risk or do nothing about the breach, changed risk evaluation models on the whole, and many a times just simply ignored the breaches, that is, continued trading despite the breaches. The 5 metrics was first the value at risk limit. So there was a 4-day war limit breach in January for both JP Morgan as a whole and the chief investment office, that is the synthetic trades. Because risk analysts concluded that the existing war model was too conservative and that war model exaggerated the true risk, the office hurriedly adopted an alternate model while still in breach of the existing model. The new model lowered the war of the portfolio or the calculated war by 50%, ending the breach and allowing the CIO to increase the risk in their synthetic credit portfolio. So when the war limit was breached, they changed the methodology of calculating the war. There was a credit spread widening limit. So this limit was exceeded by 100% in January, 270% in February, and more than 1000% in mid-April. Another credit risk related limit was the credit spread widening by 10%, or the CSW 10% limit. This limit also was repeatedly breached and the breaches were ignored in March. Stress loss limits signal the possible losses in the event of adverse market conditions or stressed conditions. Even these limits were repeatedly breached in March. So these were all internal limits and they were all internal. They should have been reported, or corrective action should have been taken at the end of the bank. That is why these limits were set. So even though these limits were there, JP Morgan traders continued to trade in the hope of covering their losses or in the hope of coming back in profit. Stop loss advisories set limits on how much a portfolio is allowed to lose and at what point losses should be covered. So at what point should you stop loss? So there were several advisories or stop loss advisory breaches also in the first quarter of 2012. So from studying these failures, what we can conclude about the deficiencies in the risk management practices is that there was a complete disregard for breaches in risk metrics. There were bank personnel who criticized and downplayed the bank's risk matrices. They even changed the war model, that is, the adoption of a new war model that allowed the office to increase risk. There were no concentration limits on the size of positions in specific instruments. So again, lack of diversification and too much concentration causing a heavy loss. Manipulating models rather than reducing risky assets. So rather than cutting their positions, they manipulated models to lower the risk-weighted assets for capital purposes. And on the whole, there was a weak management oversight and risk management oversight of the CIO office or the SCP trading activities. So these are some deficiencies that this case highlights that we should be aware of. Furthermore, JP Morgan Chase provided little information about the true nature of the portfolio to its primary regulator, the OCC. The CIO referred the SCP as a core credit portfolio, in some bank materials provided to the OCC until January 27, 2012 in a war report. The bank failed to inform the OCC of the growing size, that is from 4 billion to 57 billion to 157 billion in 15 months, the complexity and the risk profile of this portfolio. The bank provided aggregated performance data to the OCC, in essence, hiding this portfolio. So, in the aggregate performance or in the aggregate data, the losses from the SCP got made up for by the profits of the other divisions. It also provided constant assurances that everything was fine despite the growing losses. The bank dodged regulatory oversight by misleading the OCC about the nature and riskiness of the credit portfolio. We later found that despite the fact that the bank had lost over $1 billion, no disclosure about these trades was provided until when media reports focused their attention to the matter on April 6, 2012. According to the Senate's subcommittee, JP Morgan misinformed investors, regulators, policymakers, and the public by downplaying the size, risk profile, and the losses of the synthetic credit portfolio. The bank characterized the SAP as a hedging portfolio meant to provide stress loss protection in the event of a credit crisis. Daily trading occurred in these instruments, but the bank described the portfolio as one where trading decisions were made on a very long-term basis. So again, it was misrepresenting and misinforming everybody about these trades. The bank also implied that the bank's risk managers and regulators were fully aware of the size and the trading activities of the SCP. So again, when we analyze the case in hindsight, we realize that the bank was taking excessive risks and then it was trying to manipulate the laws and manipulate the reporting guidelines. So it even tried to imply that it was reporting everything to the regulators, but as we saw that only aggregate performance data was reported. So the bank essentially was hiding the losses and then using the regulatory requirements to cover up to whatever extent they could, or to hide the losses to whatever extent they could by various methods and reporting manipulations. So again, the JP Morgan case highlights losses because of excessive risk taking and because of concentrated positions. The risk management lessons that we learn again is of oversight, and even though JP Morgan didn't go bust, there was a significant loss, over a $2 billion loss that investors had to suffer. So everybody lost, the shareholders lost, the general public who had given their money to JP Morgan lost, the banking system as a whole lost credibility to some extent. So again, the lessons that we learn is that more oversight is needed and more regulatory intervention may be needed so as to ensure that these situations don't happen, and even if they happen, they are reported in time so that corrective action can be taken. The third case is titled Towards Better Reference Rate Practices, a Central Bank Perspective. Now, market interest rates like the LIBOR or the Euribor or MIBOR play a pivotal role in financial markets and the structuring and payoffs on financial instruments. So the LIBOR, for instance, please recall, is calculated as the average quoted rate of 13 large European banks. So just to refresh, reference rates link the payoff of financial instruments to standard money market interest rates and are used to determine the payments on floating rate notes and floating rate instruments. They are composed of a risk-free rate and several risk premia, including a term premium, a liquidity risk premium, and a credit risk premium. So the LIBOR, for instance, is an interbank rate. So this is the rate that bank A is offering to bank B for taking a 10-day deposit, or taking a 100-day deposit, or taking a 10-year deposit. So this rate generally will be very close to the risk-free rate, because these banks generally are big banks and high AAA rated banks. So these banks traditionally have had ratings much higher than some sovereigns also. So this rate is very close to the risk-free rate, but does include some premium for liquidity risk and time to maturity. So the longer term LIBOR would have a slightly higher rate, etc. And a credit risk premium, because eventually they are still banks. They're not as safe as the US government. So market participants that need exposure to common bank risk. So that is common risk of these 13 large banks, whose average is taken to calculate the LIBOR, would select reference rates based on unsecured interbank interest rates. So these kind of participants would be okay with a LIBOR type of rate. Other participants who need a reference rate only to reflect the market demand and supply of money. That is, they just need the treasury rate, or they need a rate that is free of common bank risk. So such participants may need a rate different from LIBOR or some other reference rate that is not affected by this credit risk premium. So traditionally the reference rate has been these LIBOR type rates, that is rates that were quoted by banks for interbank unsecured lending. 3 global trends have encouraged participants to change the reference interest rates. First is lower activity in the unsecured interbank markets. So as credit risk increases and the credit crisis has become deeper, the banks are becoming much more selective and careful about interbank lending also. So these volumes are also declining. More widespread use of secured wholesale funding. So today again, more borrowing and lending is collateralized, or more funds are given after taking collateral and are secured in nature. So again, the rates in those markets may be more representative of the current rates in the economy than LIBOR or than unsecured interbank rates. Reforms in the derivatives markets that advocate funding with little or no credit risk. So with the advent of credit derivatives, credit default swaps, even overnight interest rate swap rates may better represent the current rates in the economy, that is the current 1-year rate or the current 3-year rate, so on and so forth. So even swap rates, that is the fixed rate on a fixed for floating swap, may be used as the reference rate rather than the unsecured interbank rate or the LIBOR rate. So please note that a bank receives funds from various sources and lends it forward to various borrowers or to various corporates. Now these sources of funds can be retail or wholesale. So when you go and deposit your money with the bank, that is called a retail deposit or a retail fund. When the bank accepts deposits from a mutual fund or from another bank, that is a much higher source of funding which will come at a lower rate, or rather a higher rate. So to wholesale funds, generally the bank will have to give a higher rate because it's a big amount of funding that is coming. So wholesale funding is bulk lending to the bank or bulk funding, whereas retail funding is what happens from depositors and other participants. So to recap, we may need to change from LIBOR because first of all, this unsecured interbank market is seeing a lower volume. Secured funding is replacing unsecured funding, so rates in these markets may be more representative of the current rates in the economy. And secondly, even derivatives market have been able to present risk-free instruments. So even the overnight swap rates and the rates in the derivatives market may be used as the reference rates. We need not completely be dependent on LIBOR or unsecured interbank rates. Obstacles to switching to alternative reference rates include first, reluctance by market participants to create new reference rates, higher transaction costs and coordination challenges, user-related obstacles including existing contracts based on unsecured interbank reference rates, and accounting and risk management costs. And finally, existing accounting rules give preferential treatment to specific reference rates like the LIBOR, etc. So once the new rate comes or new rate becomes effective, what will happen to these preferential treatment is also a question marks. So there are various obstacles that deter us from changing to a new reference rate than what is existing. Now, some problems that can happen with LIBOR based or LIBOR type unsecured interbank rates as reference rates is that it may provide lenders with a hedge against funding costs, but it will expose borrowers to interest rate fluctuations of not just the risk-free rate but also the changes in risk premium. So if I've borrowed $100 at LIBOR plus 100 basis points, then this LIBOR will change because of the interest rate fluctuation as well as the change in the risk premium of these banks, because this rate is essentially not a government rate, it is an interbank rate that we are using. So this may affect the supply and demand of bank credit. So if the LIBOR rate goes too high, then the demand for credit will again go down. Similarly, if the LIBOR rate goes too low, then the demand for credit will go up because the rate is referenced to the LIBOR or to the unsecured interbank rate. So rates of these types may impede monetary policy transmission because they may behave in unpredictable ways during market stress periods. That is, even though the central bank is cutting rates because it wants to provide funds to the people at a lower rate, the banks have benchmarked their lending at LIBOR plus or based on LIBOR. So again, if LIBOR is going up, even though the central bank may be cutting rates, actual rates to the public are not going down. The incorrect use of reference rates may lead to unlimited and unpredictable changes. So if LIBOR rates are again being used as a reference for housing and mortgages also, then again the housing liabilities or these liabilities will be dependent on the LIBOR, which is again or which will fluctuate with the risk-free rate and the changes in the risk premium. So again, you should use the reference rate in places where it actually is the reference. If you're using it for all types of loans, then again it may create unlimited or potential volatility and unpredictable changes. Cross-border factors can also affect monetary policy transmission. So again, LIBOR is calculated as the average of the euro dollar or the interest rate offered on euro dollar deposits, that is dollar deposits held with 13 large European banks. If the US Fed cuts rates right now, it may again take some time before this gets reflected in the European banking system or before the LIBOR rates actually go down, because the LIBOR rate is calculated in Europe, whereas the Fed is making its actions in US. So cross-border factors can also affect the speed of monetary policy transmission. A less reliable or a less robust set of reference interest rates could negatively impact financial stability, as it may lead to a loss of confidence. Inadequately designed reference rates that transfer risk to the borrowers. As we studied, the volatility in the borrower's repayments can become very high. There may be mispricing and manipulation of the rate. If the liquidity is low, then one or two big banks may be able to manipulate this LIBOR to their advantage. Mismatches in the reference rates and the underlying transactions that create basis risk. So if LIBOR was being used as a proxy of the interest rates, or if it was used as a proxy of the risk-free rate, then even though risk-free rate may have come down, the LIBOR rate may not have come down. Hence, if you were shorting the LIBOR as a hedge against interest rate, then it may not be a perfect proxy. So mismatches in the rates and the underlying transactions can create a basis and a basis risk. Unreliable reference rates may impair central banks' ability to respond to financial instabilities in a timely manner. As we saw in the previous slide, monetary policy transmission can also get impacted if the reference rates are not good. Now please note that the interest rate in any economy at any point in time, that is the risk-free rate, should reflect only the demand and supply of money. As the demand for money goes up, the interest rate should go up. As the demand for money goes down, or the supply of money goes up, interest rates should come down. So effective reference rates or effective interest rates will purely catch this phenomena and will not be subject to other biases and other inefficiencies. So effective rates have 5 desirable characteristics. First, they are reliable. That is, there is a degree of protection against manipulation and error. They are robust. That is, they are available and their usability is intact even during periods of stress. They are frequently calculated and posted. So there is ready availability and publication of these rates, hence they are available at all points in time. And the rates are representative, that is, they are relevant to the various contracts. So you shouldn't use LIBOR based derivatives to hedge your risk in speculative bonds, because you know that speculative bonds and their risk profile would be dependent on the economy and the credit risk, whereas LIBOR would act more like the risk-free rate or will more just behave with the treasury rates. So whatever rate we are using should be representative, that is, should be relevant to the contract. So once again, effective rates are reliable, robust, frequently calculated, timely available and readily available, and are representative, that is relevant to the contract being talked about. To summarize, we can say that alternatives to traditional reference rates should be created. However, there are impediments to this process. Lack of activity, lack of liquidity, and exposure to changes in funding costs are some reasons why we may not be able to easily move from our traditional LIBOR and unsecured interbank reference rates. So the private sector should take an active role in developing procedures to determine and publish rates, using expert judgment to improve the subjectivity of the rate setting process during stress times. The public sector should also encourage the most optimal use of reference rates by removing obstacles. That is, central banks should work together with domestic regulators and authorities to strengthen the governance, monitor the rate submission process, enhance transparency, and develop public guidance. So how the interest rate is calculated, that is the averaging process of the 13 large banks or any other institution, should be transparent, should be checked, any subjectivity should be reduced so that these rates satisfy the 5 qualities that we studied earlier. The policy tools available to central banks to enact this change include verbal comments, promoting transparency in the liquidity and tenor of transactions, increasing the availability of trade volume and price information. So the central bank is the regulator of the payment system and the banking system. So if the central bank encourages better collection and dissemination of trade data, makes it mandatory to provide public information on the reference rates and how the rates have been calculated, encourages the sharing of technology and knowledge among market participants, then again these rates would be more closer to the actual demand and supply of money and would be less tenable to manipulation. Supporting the creation of markets for risk-free rates through standardizing the coverage and calculation of overnight rates. And finally, the central bank should support the reference rate transition through consultation and collaboration with the private sector, publishing legal opinions, amending accounting standards, or changing the law as may be needed. So the previous case comes, guys, because there were these allegations of the LIBOR being manipulated by banks for their own use and their own profits. So if you were short, if a bank was significantly short LIBOR contracts, you would want to suppress the LIBOR. And hence LIBOR is quoted by these banks. So they can quote or they can try to manipulate that rate. Hence we probably need a new rate that is more reflective of what is the actual market rate or the market demand and supply of money. The fourth reading talks about OTC derivatives. So over-the-counter derivatives, as we've seen, have more credit risk and do not have as much standardization. So this reading will just do a comparative analysis of the regulation in United States, European Union, and Singapore. Now we've studied earlier how the setting up of a central counterparty or a clearinghouse in futures contracts practically eliminates the credit risk because of standardization and margining and other such requirements. And we saw the central counterparty can help in netting and multilateral netting, etc., and credit risk that can further reduce the credit risk in transactions. So the central clearing through a central counterparty reduces credit risk with the central counterparty taking the opposite side of each trade. Risk is also reduced through netting, initial and variation margins, and through the introduction of loss sharing mechanism by setting up member default funds. So if somebody defaults, then we can draw upon this fund, which sort of acts like an insurance. The counterparties create transparency of pricing and default loss reduction in the OTC derivatives market. So if we set up these central counterparties, then even the over-the-counter markets will become more secure. The counterparties themselves can be structured as trusts or mutual ownerships or for-profit organizations. Centrally cleared data is reported to trade repositories. So trade repositories maintain central databases for OTC derivatives information. Both pre-trade quotes and post-trade information is reported to these trade repositories. Analysis and public dissemination of trade information is expected to help identify any risk concentrations, improve liquidity, improve transparency, and increase confidence in the markets. The United States and the European Union require central clearing and trading of all asset classes, with the United States implementing phased reporting. Singapore requires central clearing except for forex swaps, but not trading of all asset classes or not trade reporting of all asset classes. All three jurisdictions focus on data reporting to the trade repositories to improve post-trade transparency. So increasingly, everybody wants to mandate or require more and more reporting even in the OTC markets so as to improve the functioning and the confidence. So OTC derivatives are regulated by the CFTC and SEC in the United States, by the ESMA in European Union, and by MAS in Singapore. The United States is the most prescriptive in its definition of derivatives contracts. In the United States, all financial entities, all end users, and all entities above $10 billion must clear through a CCP. In the European Union, all financial and non-financial entities above a threshold have a central clearing requirement. In Singapore, again, all financial entities above a particular threshold have a central clearing requirement. So both United States and the European Union require that the central counterparty be a domestic organization, with some exceptions made for foreign central counterparties. Singapore does not require clearing only through domestic central counterparties. It allows foreign central counterparties also. So all big institutions essentially have to now trade through central counterparties so as to ensure that the risk is mitigated and default doesn't happen on the other end. Backloading of trades is required in all three jurisdictions. So above a threshold in European Union and above 1 year in Singapore. So backloading happens when a new regulation has come in or a central clearing requirement has just come in. So all trades that were previously outstanding also need to be brought in under the new regulation and the new requirement. So new margining, etc., whatever is going to happen for the existing trades also that have already happened before these regulations were in place. So backloading is also required in all three jurisdictions. That is, all existing trades also have to come in compliance with the new central clearing requirements. So even for trades that are not centrally cleared, there are margin requirements in all three jurisdictions. Central counterparties in the United States need to maintain adequate capital to cover member losses in and throughout 1 year's operations. CCPs in the European Union have a $5 million capital requirement, that is, the initial capital should be so much, and there are no specific capital requirements for central counterparties in Singapore. So if you want to set up a central counterparty or you want to be the central counterparty, then again there are various restrictions in place, because eventually the credit risk is only as good as the credit risk of the central counterparty, as we've seen. So the regulations ensure that the central counterparty has some net worth and some degree of stability. Only the United States requires almost immediate reporting of trade data to the trade repository, that is, as soon as is technologically feasible, that is usually within minutes, and real-time public reporting by a trade repository. So the highest extent of transparency is in the United States. The European Union and Singapore both allow for 1 day for reporting trade data to a repository and do not have a real-time reporting requirement for over-the-counter trades. Only the United States has phased implementation for reporting, with interest rate derivatives reported first, followed by forex derivatives, followed by commodity derivatives. The other geographies don't have any such requirement. Singapore prioritizes reporting of interest rate, forex, and oil derivatives, followed by others. The European Union does not have any phased reporting. All three jurisdictions must maintain client confidentiality. So details of the trade will be disseminated. That is, what trade happened at what price will be disseminated, but who were the two counterparties will not be disseminated. Only the United States and the EU have record keeping requirements. Records must be kept for 5 years in the United States and 10 years in the EU following the contract expiration. So that was about the regulation related to OTC derivatives in three geographies. Not a very important reading, but at least try to remember whatever has been put on the slides. More exact details of each regulation you need not memorize.